Environmental Trading Edge LLC and its members are not broker-dealers or financial advisors. All these webinars are for educational purposes only. All of our indicators and such are for personal use, non-commercial use, and are not to be construed as a solicitation of any products to buy or sell. They are not recommendations, and always talk to a financial advisor for any kind of financial advice. Past performance is not indicative of future results. You can always pause the video if you're looking at the recording right here, or review it on your own time.
What are you seeing with respect to the assets dollar, EEM, bonds, and gold after this week's macro shift?
Yeah, so it's been a volatile week. Up here at the top in gold, we have UUP. UUP is an ETF that tracks the DXY, which is basically the dollar, on a relative strength to other currencies. Now, that isn't necessarily inflation, but it's inflation in the dollar, not inflation in things getting more expensive, right? It's just a relative base of that. So just as a general overview, that's kind of what that is. The fact that we got a spike up in the dollar is not a shock at this stage in the recession, because this is the collapse stage. So we've talked about this before, that during the deleveraging stage, which was a lot of last year, the dollar will get stronger. And then during the when we start to move into the collapse stage, normally the dollar will weaken. But then when there is potential for a crash, or when there's starting to be a lot of cash being pushed on the sidelines, or even the idea that the Fed will continue to raise interest rates, so it's slightly interest rate sensitive compared to other currencies, that can strengthen the dollar. If you look back in history, and just a quick history lesson here, we'll go back to COVID here, because it's at least relatively soon. You can see the dollar was weakening going into COVID, and that was because the Fed was easing off of the brakes, easing off the gas and putting on the brake. Jesus, I'm going to say that opposite here. It is the Fed was trying to ease to calm markets down, because we had just recently had issues in the repo market, and they realized that they kind of over tightened a little bit. Then what happened is we actually had the COVID crash, right? You can see that back here. And in the midst of that crash, it really wasn't a problem in the beginning, because there wasn't a big rush to cash. It was a rush to bonds. So that's why bonds back here spiked. But then inevitably what happens is that you have this clamoring for anything safety-wise, and you're just selling everything. And you don't even care about necessarily buying into anything, because the risk in bonds started to become elevated. And that starts to drive the dollar up, because everyone's rushing to cash, basically. That's what that push is. So what we had recently, just over the last couple days, is a little spike up in the dollar. Sure, it hasn't gone straight to the moon, but did it go straight to the moon in COVID? Either. No. Yes, there was some selling, and you can see that we had some little spikes up, right? Nothing crazy, because bonds kind of took center stage. But inevitably, bonds will get kind of peaked out, right? Bonds will start to rally to a point that it spikes it up, and then they start to become less attractive. And that's when you push directly into cash, because there's no other better alternative anymore. And so that's what you'll probably see in this crash, if it transpires right now. I'm not saying that there's going to be a crash this moment. Sure, there's a lot of earmarks that it definitely can crash right now, but I'm not trying to fearmonger or anything. All I'm saying is that there's the potential right now for a pretty nasty crash. So right now, you see that bonds are rallying very strong as the market is falling off, right? And dollar has just kind of stabilized. I doubt that the dollar will become the strongest ever, or, will spike up unless we really get a deep crash, because I believe that most likely bonds will take center stage like they typically have in past crashes. And that's only in the crash that I'm sitting there talking about in general. So let me go back to 2008, because that's kind of let me zoom out here. See, this is my weakness with trading view right here. Let me get back to, yeah, there's '08. Okay, so you can see here, same type of situation in the actual crash itself. Bonds started to go up in this crash that drove right here, right? And then right when bonds started to cap out, you saw the dollar start to strengthen, right? And then inevitably what happened was the Fed came in near the lows, right, and sat there and re-stimulated, started to push back on mortgage-backed securities and pumping new money into the economy, and that's when the bonds really spiked. But that was also that they were devaluing the currency. So when the Fed actually goes into stimulus mode, and remember that's the last stage of the recession, we're not there right now. When the Fed goes into stimulus mode, that's when the dollar gets crushed and bonds go up, right? Because everyone wants further dated currency, not closer dated currency, because they're basically destroying it right now. So keep that in mind, that through this crash in '08 that we had back here, first bonds took off in the initial crash. Then once they spiked really aggressively, boom, the dollar takes over at the end of it and takes off and finishes it the rest of the way until we get to the stimulus stage, which typically happens pretty quickly after a crash. We're basically expecting a rate cut in June now. So we were, by the way, before this move right here, before the bank failures, the market was expecting a rate cut in November, December time period. So we've pulled forward the expectation that the Fed is going to cut rates earlier. Mm-hmm. By the way, inflation is still at 6% year over year. So in order for the Fed to want to cut rates, it's got to get really bad out there, right? Mm-hmm. So just kind of keep that in mind, what the market is telling us, right? If we put our ear to the ground, is the market very happy about what's going on right now? We've got bonds spiking, we've got dollar stabilizing, we've got risk assets dropping, right? And we've got expectations that rate cuts coming more forward in time as well. That's not a good situation. That's typically, like I said, a recipe for a crash. Gold will follow bonds, and will actually favor even more through an inflationary recession crash. So there is a preference into gold here soon. First you'll normally push into bonds, and then gold will come through. I can throw that up here. We'll just put GLD up here, so that way you can kind of see what that happens. GLD is in purple back here. So you can see here what ends up happening is stocks or bonds normally take off first, and they're the most aggressive, right? Gold was still going up. Don't get me wrong. Gold will still go up, right? Because it likes interest rates being expected to be lower. So that's a good thing, right? So as bond expectations or as rate hikes have come down, gold will start to spike up. But then what also happens with gold is as the devaluing of the currency that happens from the stimulus stage is where gold really takes off through the moon. So you can see here, after the Fed pulled interest rates down in COVID and was stimulating and printing new money and throwing it into the system, that's when, boom, gold went through the roof. And then eventually that stimulus was basically that devaluation was kind of capped out. And you can see that the dollar kind of stopped falling for the most part, and then gold kind of cooled off and everything kind of cooled back down, because interest rates eventually do affect gold as well. So that interest rate combination, it's kind of like a currency / bond relationship that gold has. And that's what happened to it. As far as EEM is concerned, that's emerging markets. We use that normally to counter the effects of gold. So if you ever see in our portfolio a mixture of EEM and dollar, it's normally because we're in both of those at the same time to match each other, but we have positive growth potential in the actual emerging markets because they are an equity themselves. So they can go up as our dollar actually still comes down.